Welcome back. Since the US election, the stock market rally has been driven by material and banking stocks, and as a consequence, some really good companies have been dumped because of the rotation into financials and mining stocks. Roger Montgomery of Montgomery Investment Management invests in companies that look like good values. So let's find out how he's viewing some companies he likes that are currently out of favour and with the market, and also, and what companies does he like going forward? Roger, good to see you, mate.
Nice to be back.
Okay, now let's get rid of some viewer questions. And I know you said to me, why do viewer questions always have to be negative? Well, that's just the way it is, yeah.
Right.
When I was tipping BHP...
So it was about Isentia.
Isentia, of course, the company you've always liked.
We have and still reserving our opinion at the moment, but we still think it's one of the highest quality businesses out there. But what happened was they bought a business called King Content, which isn't their core business. The losses were greater than what the market anticipated. It's going to take longer to get to profit. They had a couple of key salespeople leave early in the piece, which meant that they weren't going to keep all of their clients. So they have to rebuild that business. Now, they've brought a bloke in from Bauer Media. They reckon he's really good at this sort of stuff. We've got to reserve our judgment because we haven't seen whether he's done a good job yet or not. The issue is, it's very simple. The issue is, can they maintain their margin and their market share simultaneously? That's the issue. So their average revenue per customer is still going up. Okay, that's not...
And that was a key indicator that you looked at and you gave a tick to.
One of the things we like. Yeah. We love it when you can raise your price and you get more customers. And they've been doing that in Asia, but the Asian business is obviously much smaller than the Australian business. They've been doing it in Australia, but what happened in the last half was they were about to raise prices again, and then Meltwater came in, another group, an overseas-owned group, and discounted their price for the digital side of the business. Now, the digital side of the business is, again, a smaller part of the business, but the question is it the growing part of the business compared to the rest of the business? So, look, we bought a few more shares.
So you're dollar cost averaging?
Well, we bought a few more. We own a lot, and we bought a few more. But just remember, this is part of a portfolio of 26 stocks or 27 businesses, and we've had REA reported a great result. We've had Healthscope reported a much better result than what the market was anticipating. We've had IDP Education report another great result. Car Sales has reported another great result. ResMed's result was great. Challengers was phenomenal. So, in the portfolio, it's a smaller position, and yes, we are, look, if it doesn't work out, it will be an own goal. It will be, and that happens from time to time.
To explain to our viewers, you would be interrogating this company very, very closely to confirm that you're not...
And we dragged them over the coals. We had 4 of our guys in our boardroom today with the CEO and the CFO, and doing the same thing again.
All right, but you've been in the game a long time, and I actually remember a Celebrated case where you actually got really nasty with the CEO that didn't actually
tell the truth.
Yeah,
I was the first fund manager in Australia at the time. I was in a business, and we were the first fund managers in the country to launch a class action on behalf of shareholders against a publicly listed company. And that case was won for the plaintiffs, and they got back some cents in the dollar.
Yeah. So therefore, when you seemingly get it wrong because the market doesn't agree with you, you do actually drill down to make sure that...
Oh, absolutely.
Ultimately, it's not just a matter of your reputation.
We are frivolous about this
You're
stuff.
Trying to make money.
We're there to protect our investors' capital, and Isentia's market cap is down $700 million, from $1 billion to $300 million. It's not a happy story. My fear is that people watch the show, Peter, and they hear me talk about a company. We only get time to talk about 1 or 2, not the 26. So they're not buying a portfolio. I'm worried they don't do their own research and they rush out and they put an inordinately large proportion of their portfolio in one name. And that's not the way we invest. We invest as part of a portfolio. But the market at the moment is really interesting. Now, I've brought 4 slides in. Do we have time to go through those? So are they? I sent them into your office. Did they load them up?
Well, I'm hoping so, mate. I've got to say.
Well, let's find out.
Let's find out. Do we have slides for Roger? Directing. No, we don't.
Okay, no problem. All right, so I'll go through it.
But
here's the interesting thing.
After working radio for so long,
Yes.
we can describe what our viewers aren't seeing.
And you know I've done it many times before.
Fire away.
So imagine for a moment I'm giving you the opportunity to start a business. It's 2007.
Yeah.
Okay, you're going to put $4 billion of your own money in,
Yep.
and $34 billion of retained profits from your other businesses. So call it $37, $38 billion of your own money.
Business.
Yeah, some people would stop at that point, but you're going to reinvest it in this business. We're going to borrow $14 billion from the bank as well. I'm going to run the business for you for a year, and at the end of the year we make $16 billion profit, which is about 40, call it 50%. Roughly on the capital that you've put in, the equity that you've put in. You're delighted with that. You say, Rog, amazing effort.
Genius.
Keep going. Now, it's a resource business. Between 2007 and 2017, we've had one of the greatest resource booms in the world's history. And so you've decided the right thing to do would be to expand the business. Let's make more money. So you put in another $1.4 billion of equity directly. You, instead of taking dividends, you retain another $35 billion. So you've doubled the retained profits. You've added another about 35%.
This is the kind of business you'd like.
This is not the business that I like. And the debt's gone from $14 billion. You haven't paid that down yet.
Okay, right, yeah.
It's now $50 billion. Now, you would expect with all that capital and the greatest resource boom that we've ever seen, that the profit from $16 billion 10 years ago should be higher than that today. Well, this year it'll be about $8 billion, and last year it was 1.4. And that's after 10 years. Now, that's BHP. Right?
Yeah.
Now, another business that we really like, we don't like those economics.
Yeah.
Buffett once said, if you're not prepared to own the whole business for a decade, don't own a little piece of it for 10 minutes. Okay, so another business that we do like is a business where you've put in 5 times as much equity, but your profits have gone up 15 or 16 times in the last 10 years. And the debt's been paid down to zero as well.
Yeah.
So now, that's REA Group, by the way. Okay, so which business would you rather own? Clearly, if it wasn't listed, you'd rather own REA rather than BHP. And yet in the last 12 months, BHP's share price is up about 75, 76%. And REA's is unchanged. And in fact, since July, REA's share price is down 30%. So the performance of our funds compared to the market doesn't look very good this year because we've basically treaded water.
You're backed a company that really should be loved by the market, but has not been loved.
Well, for the last 4 years, it has been.
That's my next question.
For the last 4 years, it has been. So if you go back, let's go back 10 years though, and over the last decade, BHP's share price is up 9% in 10 years. Yeah. REA's share price is up 18-fold, 1,800%. Okay. So we know that in the long run, the share price will track the performance of the business. So people who've bought BHP, are they wise investors in businesses, or are they what I think it was Seth Klarman called lucky idiots? You know, they've just flipped a coin.
I was putting idiots
gone
in
up
at $15, $16.
Well, you know, maybe you're just lucky. But so it's not a good business to own outright. You would feel a lot of pain if you own that outright. And it's just because it's listed and people are speculating on the iron ore price going up. And by the way, record supply of iron ore stocks on Chinese major Chinese ports at the moment. The spot price of iron ore is currently 57% above the 90th percentile highest cost producer. So 90% of all producers are now making money at the current spot price. And BHP's share price today is implying an $80 per tonne iron ore price forever. And that's very unlikely because it's a cyclical commodity.
But the bottom line is, the question would be, why doesn't the market like REA? Like, it's all very well to compare BHP. Forget that for a moment.
Yeah.
Why? Is it partly because...
Well, there was a huge rotation during the year, and when we looked at the major... You know, I'm talking about the Colonials and the Perpetuals and all those big funds. When we look at their exposure to resources at the middle of last year compared to now, in some cases it's gone from 0% exposure to a quarter of the portfolio.
Correct.
Right? So what happened is... But there are a lot of those big, older funds, that have baby boomers as their clients have seen massive outflows. So they haven't got fresh money coming in to buy those stocks. That means they had to sell something. And what they sold were high growth, high quality mid caps.
Okay.
And so brokers
Like
around
REA,
the world,
like REA.
So brokers around the world like Credit Suisse and UBS, they're talking about a rotation out of quality into value. But they're not the quality value, they're just cheap stocks.
So what you're arguing is, and this is going to be
Temporary.
temporary. So you say REA looks like good value, despite the fact that Domain, will be a listed.
Makes no
rival.
difference if it's listed or privately owned. It's the same business it has been. It's still the second runner. It's not the first.
Is part of REA's sell-off because the market sees potentially Domain might be a better run business as a standalone operation?
I don't think so.
Okay.
But I do think they might have. So it's possible that some fund managers, and I don't know because I haven't spoken to them about this, but it's possible that in anticipation of a Domain float, they've sold out of some of REA because it might make sense to them to have a bit of each rather than be exposed only to one.
Because there'll be an oligopoly. One will be better than the other, but there'll still be an oligopoly.
Yep.
All right. So therefore,
the business doesn't change. If it's listed, it's the same business it is today.
And let's be clear on this. REA, you have total confidence in.
Correct.
Isentia, the jury's still out on it.
We're doing more work on it. We've bought a little bit more. Yeah. We're doing more work on it. We haven't changed our view yet. I'll let you know if we do.
Yeah, most definitely. My viewers would love it. Because there will be some people who will say, well, OK, Roger's a smart guy. He's got a lot of things right in the past. We've got things wrong.
Remember,
we all do.
We're going to get things wrong.
Yeah.
TPG...
Yeah.
Isentia could be one, TPG was one last year. But, in the portfolio, when you're running a team, you're eventually going to have some players that are benched. But, you hope you've got good enough players on the rest of the team, you're still going to win.
Have you done any homework on Vocus? Because Macquarie got back into Vocus 3 weeks ago.
Yes.
McCarthy tonight said he's starting to like Vocus.
Our personal view is it's too early. The dust hasn't settled on the telco industry. The move to NBN is going to mean a lot of margin compression for everyone. And when you look at what Telstra's doing, Telstra's looking to cut costs. Their result wasn't that good, and they're looking to grab back market share. So they're being very aggressive with pricing, and that's going to put more pressure on second-tier players' margins.
Yeah, one of my viewers did actually ask the question. Do you think Andy Penn is kind of out of his depth running Telstra? Have you formed a view on Andy Penn?
Well, we've not really...
You've never been a Telstra fan?
Never been a Telstra fan. I think it got close to intrinsic value once at about $2.60 and that's really been it in its life. But its profits have not grown in a decade. I don't think it matters who's running it. Changing the economics of that business is just too hard.
Roger Montgomery, thanks for joining us.
It's a pleasure.